Hello guys, welcome to today's training video. Today we'll be looking at common forex trading terminologies. Overview for today's class is long or short, leverage and margin. We're talking about the PEEP, the bid and the ask, spread, and at the end of today's class, we're having a summary of all wavelengths. If you're watching our video for the very first time, make sure you subscribe to our YouTube channel, like our video, and turn your notification post on so you don't miss any of our videos ever again. Thank you, and let's get started. What is long or short in the forex market? Long or short simply implies the direction of the trade you are taking. That's just the simple definition for long or short in the forex market. So whenever you hear long or short, it's simply person is or the trader is trying to imply the direction the trade is going to take or the direction the trade is taking. For example, long simply means where to buy, and short simply means where to sell. For example, if I say, okay, on the AUD USD, I went long, it simply means I bought the AUD USD. Means I'm in support of the Aussie against the dollar. That's I'm supporting the Australian dollar against the US dollar. If I said I went short in the AUD USD, simply means I sold. I'm selling in the AUD USD market. That was I'm supporting the dollar against the Aussie. You're on the Australian dollar rather. So long or short simply means the direction of the trade or the direction the trade is going to take or the direction the trade is taking. And also the last but not the least, one thing you must know about long and short, you can also refer to them as the bullish or the bearish. The bullish or the bearish. So long simply means bullish, to buy, bull, bull. Short simply means bearish, bear. So that's just all on long and short. So let's move forward. The leverage and the margin. The leverage and the margin. Leverage is simply the term that refers to how much larger you can trade relatively to your account size. It simply means if you have a trading capital, let's say a trading capital of 1,000 US dollar, when you say you can trade to the tune of 50,000. You can trade to the tune of 50,000. So your account size can collect this amount, 50,000. You get what I say? That's if you have the if your capital is 1,000. You want to say? Are you getting me? So once you have a capital of 1,000, you can trade to the tune of 50,000 in the forex market. Why? Because your broker is going to be giving you a leverage of 1:500. 1:500. So if your broker gives you a leverage of 1:500, you can trade this exact amount in the forex market. You can trade to the tune of 50,000 USD from a trading account of 1,000 USD. You get it? So that's what leverage is all about. Then moving forward, what is the margin? The margin is a other side of the coin as referred to leverage. I'll explain. It's also something you must know that I'll explain. One thing you must note that the margin is the other side of the coin as refers to the leverage. I'll explain. It is the amount or the percentage you should put in your trading account before you are allowed to trade. The percentage you are allowed or you are expected to put in your trading account before you trade. The amount you expect to put in your trading account before you trade. Like for instance, now we have this as the leverage. Good. So now if you divide this, it is actually 2%. It is actually 2%. You can see it's actually 2%. If you divide 1:500, it's actually 2%. So now you are willing to put 2% of this leverage in your trading account before you're able to trade. So imagine you want to trade to the tune of this 50,000 USD. You are allowed to put a 2%, which is 1,000 USD. You understand? So this is what margin simply means. Margin simply refers to the percentage you should put to be able to trade a particular kind of security in the forex market. So is that understood? Let's move forward. Let's move forward. Okay. Now we are here on the PEEP. What is the pip? The pip is the smallest movement in the forex market. This is the unit of measurement in the forex market. Like you know, to measure length universally we use meter. You understand? We use meter and centimeters and so on and so forth. To measure weight we use kilogram. So to measure the movements in the forex market we use the word called pip. So it is the smallest movement in the forex market. So for every movement made in the forex market, it is calculated based on pip. You want to say? Then we also have what we know as the pipettes. This is not commonly known or commonly used in the forex market, but it is something you should also know for the knowledge sake. It's known as the smaller movement in the forex market. So now, you know, mind you, we talked about the long and the short. We talked about the long and the short. So if I say I went long in the AUD USD, so I'm expecting the market to go 35 pip. You want to say, what I'm trying to say is that in this forex market, I'm going to be moving 35 pip in the long direction. That's I'm going to be buying 35 pip in the AUD USD market. That's all I'm simply saying. So pip is the smallest movement in the forex market. Take note of that. Let's move forward. Another thing again in the forex terminologies is the bid and the ask. The bid and the ask. Note when you are trading in forex, is not you're not trading on just one price. There are two prices actually in the forex market, and these two prices is known as the bid and the ask. The bid simply means where you can sell at, and the ask simply means where you can buy at. So this is what is known as the bid and ask. The bid is where you sell at. The ask is where you buy at. Mind you, you can't buy a commodity for $50 and want to sell it for $50. You won't make profits. So you want to sell it for either $60, $70 or $80. Some will sell it for $100 depending on the value of the commodity. So same it is also in the forex market. You don't buy at the same price and you don't sell at the same price. So it's as simple as that. Note in other markets than the forex market, the ask and the bid price are somewhat different, like in the stock market and the futures market. But yet today we're talking about the forex market, because I know majority of you watching this video are forex traders. So now on the spread, the last but not the least, I believe, the spread. The spread simply means the difference or the distance between the bid and the ask prices. You want to say, mind you, you are buying a commodity for $50 and you want to sell it for $100. That distance between the $50 and the $100 is the spread as regard to the forex market. That distance, that profit margin you are going to make is what is known as the spread in the forex market. Let me just do some example here so that you can relate with. So here is $500, good, and you are selling at 1,000. So if you simply say 1,000 minus 500, which you had earlier, it will be equal to what we know as, to be equal to 500. You get it? So in other words, if you minus this 500 from this 1,000, you minus it from this 1,000, you'll be getting this 500 here. So this 500 we have here is the spread. This 500 we have here as the distance between this 1,000 and this 500 is the spread. I go around to say, because if the difference between this 1,000, which is the the price you are selling at, and the price you bought at, is this result, which is the 500, and is also known as the spread in the forex market. So I hope you understand this. These are just simple things you must know why trading the forex market. These are common forex trading terminologies you must know and have at the fingertip, so you know which market to trade and which markets to leave, because you don't want to be buying you don't want to be buying at $100 and be selling at $50. You're not making profit. You want to say, because some markets, the spread, the distance between them are so much that you better leave them than trade them. So now I think we've come to the end of today's class. We'll be going through a summary of what we've learned today. Long and short simply implies the direction of your trade. the more leverage you trade with, the easier it is for you to blow your trading account. So with proper risk management, leverage is pretty much irrelevant. So in other words, I'll explain that I didn't talk about that earlier. What you're trying simply implies that if your broker gives you a leverage to trade on a trading account capital of 100,000, sorry, on 1,000 USD, and you're trading up to 50,000 USD, the possibility of blowing your trading accounts is very real. You want to say you can blow up your trading accounts in little or no time. You want to say, but with proper risk management, with understanding what you are going to the amount you are supposed to risk in the forex market, it's going to help you, because you can't just say, okay, I have 1,000, and my capital is 1,000 USD, and my broker can give me the opportunity to trade up to 50,000 USD, and you just put 50,000 USD into the market. Mind you, the pip, once the pip just move one, there's no background, no foundation to support it. So you are going to blow up that trading account instantly. You're going to say, you're going to blow it up. But the only benefit is if it goes positive, also, you're going to make massive profits on that account. You're going to say, but the possibility ratio to the possibility of you blowing up your trading account is very, very, very real compared to you making profit from the market, because the forex market is unpredictable. You can't say, okay, this is how the market is going to go, except you have developed yourself over time. You want to say with a quality trading plan and a quality proper risk management, which you're going to be talking later on in this YouTube channel. So now another thing you must know is a pip is a point in percentage. You want to say a pip is a point in percentage. A pip is a point in percentage, and is this movement in the smallest movement in the forex market. For most currency pairs, we have the fourth decimal place, like the yen market, and in the other currency we have like the second decimal place. So these are points in percentage. You know them as you start trading the forex market. The bid price is where you can sell at, and the ask price is where you can buy at. And the last but not the least is the spread. This is just the difference between the bid and the ask, and this is how your brokers make their own money. This is how your brokers make their own money. So we've come to the end of today's class. Thank you for watching today's video. See you in the next video.